The Snyder Method is a long-term strategy that uses a powerful combination of buying stocks, selling options, and cash management techniques to generate portfolio income. But I'm not going to make the assumption that you know how to trade options. And moreover, our conversation today isn't as much about the vehicle that you use to invest with as much as it is that you can walk away with an understanding of how cash flow investing is crucial to your retirement readiness. So I'm going to walk you through an example of investing for income, but instead of using options, I'm going to use real estate as our framework, simply because real estate tends to be much easier for people to conceptualize. This example will give you an easy and very practical look at how income investing compares to the traditional capital appreciation model of investing. So imagine we have two friends, Cat and Cash, and we'll start with Cash. So Cash is a younger guy, still working, still collecting a W-2 paycheck, but he's been able to save $100,000, and he uses that money to buy a house. His goal is to use that property to collect $1,000 each month in rent. So what happens if the value of his rent house drops by 20% in the year after he buys it? Nothing really. Because his focus isn't on the value of the property. His focus is on the income he's collecting each month. I mean, even if the value stays declined for, let's say, 2 years, it's not a big deal to Cash because he didn't buy that property to sell it. He bought it simply because it allows him to collect rent month after month. Now, on the other hand, let's look at Cap, our capital appreciation investor. He's also young, still working, but he takes his $100,000 and buys a piece of raw land in a part of town he anticipates will have growth in the future. So he buys his land and holds on to it, hoping the price will increase over time. What happens to Cap if, just like with Cash, the value of his land drops 20% during the first year and stays down for 2 more years? Well, he's simply left holding a piece of property that's worth $80,000 instead of $100,000. And along the way, he hasn't made one thin dime. Now, the argument could certainly be made that Cash's property is only worth $80,000 as well, and that's absolutely correct. But here's the difference. His first year out, assuming he collected $1,000 in rent each month, he made $12,000. After 2 years, he's collected $24,000, and after 3 years, he's earned a total of $36,000 in rent. So even though the value of his asset is down, he's still ahead. Not only is he ahead of the capital appreciation investor now, even when the market recovers, he's still ahead because all along the way, he's been collecting income. Although both investors could now sell at a profit, because of the income, the cash flow investor could sell at a bigger overall profit. But why would he sell? If he did, he'd simply go out and find another piece of property that served the exact same purpose. The critical data here is that income investors buy their assets to use them, not to sell them. And this is a surprisingly hard concept for investors to remember when they make that really powerful move from focusing on capital appreciation to focusing on using their assets for income. It's really a significant paradigm shift. But once again, it gets back to that basic question of how do you make money? Are you going to wait to make money when you sell an asset, or are you going to make money because you know how to use your asset?